Welcome to Investors Insights. Our topic today, facts over emotion. So often people want to make emotional decisions in regards to market swings, their portfolios, what's going on in the world. And we're here today to address some of those issues. I'm joined by my distinguished colleagues, Bobby Norman, Trey Booth, and Ty Miller. We've just had a great portfolio strategies meeting here at Five Plan Partners, and I'm thrilled about the information they're going to provide. We like to stick with the facts. We like to stick with the data because that will cut through the emotions. And so first, Bobby, I want to go to you because in this information age, everybody's getting all kinds of news about world affairs, geopolitical, and it's really causing some anxiety out there. You addressed it beautifully this morning. Talk about that.
Yeah, so in a meeting last week, I had a client let me know that they're worried about the conflict going on in the Middle East and with the continued conflict with Russia and Ukraine. And they were asking if they should reduce risk to stocks until the situation calms down. So I want to share our thoughts on that topic. Obviously, there is a humanitarian crisis that cannot be ignored, but our focus is on how the conflicts impact the markets and the economies around the world. And obviously, the first area we're watching is the impact on natural resources, such as the price of oil, because that will be the biggest impact on inflation, corporate profits, and consumer spending. And we're also watching the shipping and logistics issues in the Middle East, which will continue to have an impact on inflation as well, something we've talked about in previous vlogs in recent weeks. And as you can see in this chart, historically, the market shrugs off these type of geopolitical events. And this chart shows historically how the market has performed, the S&P 500, how that's performed around invasions and conflicts going back to 1950. And you can see that looking at the 13 different conflicts, including Russia invading Ukraine, that the market historically recovers in the months following these events, which can be seen in the blue line that shows the average performance in the following months after conflicts and war. And so while each conflict is different, it has historically been a prudent investment strategy to stay invested in a diversified allocation based on each individual's long-term plan. It's something we'll continue to watch the current conflicts carefully, but it's important to note this isn't the first time and sure will not be the last time that geopolitical events cause market volatility. So it's something we're used to. We've been here before, and it's important to stay diversified and stay on the long-term plan.
Yeah, that's well said. And I appreciate the chart also that you did the research on, because I think that chart goes all the way back to 1950. And you look at all the crisis scenarios and so that's very important for people to realize. We've had these upsets before, but in the long run, the markets recover. And so, Bobby, great job on that. And also, folks, let me say this. In relation to your financial blueprint here at Five Plan Partners, we determine what rate of return you need or better to get you to those dreams and goals. And so we're doing that every day, striving to keep on track for that. But this is a good example about, yes, the news is out here, things get volatile, but we also are watching it from the planning side as well as portfolio strategies. And Trey, Super Bowl weekend, I'm with a lot of people, and the big topic was definitely the one Bobby brought up, and also what you're bringing up today, inflation. People talking about how much it costs to go to the Super Bowl, how much things have gone up in price. Will inflation ever come down? And I'll also say, for those tracking us, go back to previous vlogs, we've continued to have this topic and give you insight on it. So share with us about inflation and what you're seeing out there.
Yeah, thanks, Greg. Absolutely. Inflation is where Wall Street really crosses with Main Street, and that it's of all the economic indicators we track, it's the one that our clients feel most directly, and definitely the one that where we look at markets and planning, and that's where they cross as well, is the cost of goods and where we see that going and where it's been. And so it's been a very important data point for us. And the headline CPI is going to hit the print tomorrow. And there's a lot of different inflation indicators, core PCE, PPI, core CPI, super core CPI, all those we kind of a lot of those are important, but a lot of them are also noise. We try and keep an eye on what is headline consumer price index, because that's what majority of the people feel. And that's the one that's been tracked the longest. And so a lot of economists are trying to cut out parts of the inflation they don't like. So we try to look at the overall. And if you look at this chart going back to 2022, it shows a clear downward trend of inflation going from 9% down to 3.35% at the last print. So it looks like inflation seems to be easily in a downtrend. But then if you zoom in over the last few months on this next chart, you can see it's very much in an uptrend right now, and that's what's concerning. So if you pull the timetable back, clearly a downtrend. But what the Fed is watching, what we're watching, is this concerning uptrend where inflation doesn't seem to be going down to that 2% rate that the Federal Reserve targets that we've been used to over the last few decades. It's stubbornly staying above 3%. And tomorrow's report is expected to drop below that 3% range. So that'd be very important because that would break the recent uptrend that's been in place since June of 2023. So that's not a short uptrend. That's a multi-month trend. And so some are watching very closely. Not very optimistic, though, because we have seen inflation surprise to the upside over the last few months. And so that may be something the Fed is seeing that market isn't anticipating, but we're watching that very closely because we'd really like to see it come down and continue that downward trend, but we're not so convinced that'll happen.
Right. And at this point, Trey, when you say the Fed's done an excellent job, because the big fear is they would drop rates too fast and inflation would come back stronger than ever.
That's so the Fed definitely was late to the game, and the biggest risk now is that they step away too soon because inflation traditionally inflation comes in multiple waves, and the reason it does is because the Federal Reserve backs away too soon. Money starts to be printed again, and you have inflation come whirling back. And so it's really important that the Fed not count this as a win, which at the end of last year, there was a lot of talk around the Federal Reserve meeting back in November around them pretty much taking a victory lap and claiming success over inflation. That's something that's a little concerning considering we still see inflation well above the target.
And another example of facts over emotion. Emotionally, everybody wants rates to go down. Mm-hmm. But in terms of facts here at Five Plan Partners, we have fully believed for some time the Fed needs to be tough on inflation because that's been the mistake of previous Feds. So great insight there, Trey. And then especially facts over emotions. Ty, a big topic I also run into on a weekly basis is about earnings and markets. And you had great insight on that this morning because people can make knee-jerk decisions based on emotion and not really look at the facts. Talk about that.
Yeah, we just kind of got through earnings season here. There's been a lot of talk for the last year plus of the Magnificent Seven, the 7 biggest companies in the world, and how concentrated the market has been. The Magnificent Seven makes up about 30% of the S&P 500 now, which is very outsized compared to historical comparisons. But that could be justified if you look here on this chart of the S&P 500 2023 earnings performance. The Magnificent Seven grew earnings by 31%. The rest of the S&P, the other 493 stocks, 1.9%. So pretty big difference. That led to the overall S&P at 6.2% growth. But again, a lot of that was driven by the Magnificent Seven. It was even more noticeable if you just look at the fourth quarter here, the one we just got through. So you have the Magnificent Seven growing earnings at 60% almost. The S&P up a total of 7% in earnings. So a fairly, good earnings season. But the rest of the stocks other than the Magnificent Seven down about 3% on earnings. So we would like to see, more broad-based participation, especially in the earnings side of things. That being said, looking to 2024, Magnificent Seven is only supposed to contribute about 21% earnings growth, with the rest of the 493 stocks at more 6%. And so it'll be important to see how these ratios kind of play out through the rest of the year. At 6% from the rest of the 493 and a 9% earnings growth of the S&P overall would be a bright sign and a build off of last year's kind of subpar earnings performance from the rest of the stock market.
Yeah. So in relation to facts, over emotion, people go, well, the market's been real strong and going up, but the Magnificent Seven has driven a lot of that, correct?
Yes, that's correct.
Yeah. And so we're looking to see how the rest of this market does as we continue into 2024. So folks, we like to bring you information. And with that information, we hope you get knowledge. And we want to thank you for sharing the knowledge that we're giving you to others, your colleagues, your neighbors, friends, and family. We also appreciate all the feedback, and you've heard throughout this vlog how we're talking to clients, about their concerns, anxieties, things that they're hearing or seeing. Well, we are wanting to relay this to you through our blogs, our podcast, our social media, LinkedIn, Twitter, Facebook, YouTube, multiple ways so that we can get the information to you as quickly as possible, as well as the emails that we're sending. We also like seeing you one-on-one. And in this 21st century, whether it's through Zoom and WebEx or in person, we like those kind of meetings. So just know we thank you. Those of you that have money with us, we cannot thank you enough for believing in us. And just know that every day we're striving to see to it that our clients have a better, richer, fuller life. Have a great week. Talk soon.